Friend, thank you for being here today. I want to start with a simple confession. I could have been twice as rich today if I hadn't made one dumb mistake 50 years ago. That's not me being dramatic. That's arithmetic. Compounding doesn't just work on your gains. It works on your stupidity, too. And that leads us to a hard truth most people don't like to hear. By the time you hit 50, most of your big moves in life are already behind you. Your career trajectory is mostly set. Your family situation is largely what it is. And your ability to take wild, reckless risks? It's basically gone, unless you enjoy gambling with your retirement, which is about as smart as putting your house on a roulette table. After 50, you don't need brilliance. You need to avoid disaster. People love talking about finding the next Tesla, catching the next crypto boom, or striking it rich in some hot new sector. That's noise. At 50 and beyond, the real game isn't chasing jackpots. The real game is survival. I grew up during the Great Depression. I watched people lose everything, not because they were stupid, but because they borrowed too much, trusted the wrong people, or assumed that good times would last forever. The pattern repeats every generation. The faces change. The stupidity doesn't. So here's my #1 investment rule if you're over 50. Play defense, not offense. You already had your offensive years, your 20s, 30s, maybe 40s. That was the time when risk-taking could make sense because you had decades ahead of you to recover from mistakes. But at 50, the clock is no longer your friend. Your margin for error is small and shrinking. Most people don't understand this. They hit midlife in a panic and decide they're behind and that they need to catch up fast. So they pile into hot stocks, speculative schemes, or get-rich-quick ideas. And then they blow themselves up faster than they can say retirement plan. I once knew a very bright man, top education, top job, top income. At 55, he felt he had less than his peers. So in the late 1990s, he threw a fortune into dot-com startups. By 2002, more than half his net worth was gone. He spent the rest of his life talking about what he almost had. A waste of intelligence and a waste of capital. The irony? If he had simply parked that money in boring, dependable companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson, he would have been just fine. Not glamorous, not exciting, but secure. And after 50, sometimes fine is exactly what you need. Because the real enemy after 50 is not underperformance. It's catastrophe. Losing half your net worth at 30 is painful. Losing half of it at 60 can be fatal. At 30, you may still have 30 or 40 working years ahead of you. At 60, you might not live that long. You don't have the luxury of a major reset. So you must shift your goal from being clever to not being stupid. And believe me, avoiding stupidity is a full-time job. If you're over 50, forget chasing unicorns. Forget trying to be the smartest person in the room. The smartest guy in the room is often broke, divorced, or both. Your goal now is durability, staying power, having enough money to outlive your mistakes. I like to say, all I want to know is where I'm going to die, so I'll never go there. In investing after 50, all you need to know is what can wipe you out and then never go there. That means avoiding leverage. Debt is financial poison, especially when you don't have decades to work it off. It means avoiding speculation. You are not going to outtrade a 25-year-old sitting in front of 6 screens with no children, no responsibilities, and no life. It means avoiding complexity. The more complicated a deal is, the higher the odds that you are the sucker at the table. At 50 and beyond, your best strategy is to keep things boring. Boring works. Boring compounds. Boring lets you sleep at night. The financial world does not reward your need for excitement. It punishes it. That's the paradox. The less thrilling your investments are after 50, the more likely you are to have a thrilling retirement. Don't aim to get rich quick. Aim not to die poor. Now let's talk about one of the most destructive forces in investing, envy. Envy has ruined more portfolios than recessions ever did. People don't usually go broke because they can't earn. They go broke because they can't stand to watch someone else earn more. I've called envy the dumbest of the 7 deadly sins, and I meant it. Why? Because it's the only one with no payoff. Greed? At least you get to spend. Gluttony? You get to eat. Lust? There's some pleasure. Envy? You just sit there stewing in resentment while the other guy enjoys his life. And envy is contagious. Your neighbor buys a luxury car, and suddenly your perfectly fine car feels inadequate. Your brother-in-law brags about a 10x stock, and suddenly your steady compounding looks like a mistake. That's when people abandon rational plans and dive into trouble. In the 1990s, Warren and I owned deeply boring businesses: insurance companies, candy, furniture stores, newspapers. Meanwhile, kids in Silicon Valley were becoming billionaires on paper almost overnight. To many people, we looked old, slow, outdated. Then the bubble burst in 2000. Those paper fortunes vanished. The people who laughed at our slow approach were broke. We were still rich. The lesson is simple. The game is not about beating other people. It's about not losing yourself. Envy makes you forget that. I once knew a man who had invested fairly well for years. Stable returns, decent savings. Then his golf buddies hit it big in oil stocks. He couldn't stand being the small timer. He leveraged up and chased the same trades. When oil crashed, so did his portfolio. His buddies lost money too, but they still had careers. He only had his retirement. At 50 or older, envy is lethal. You don't have time to rebuild from your own stupidity. One envious decision can destroy decades of discipline. The best investors I've known had almost zero concern for what others were doing. They didn't care what their neighbor bought. They didn't care what TV pundits shouted about. They cared about staying solvent and compounding quietly. If you want a peaceful old age, you should actually root for your friends to succeed. Envy makes you miserable when others do well. That's a terrible way to live. Imagine being 80 and still bitter because someone else had a bigger house. What a waste. I've outlived many people who, at one point, were richer than me. I never envied them. I knew many of them were playing games that couldn't be won long term. Sure enough, they burned out, lost their money, or destroyed their lives. Meanwhile, I stayed boring, rational, and alive. So if you're over 50, here's advice you can bank. Stop caring what anyone else earns. Stop measuring your life against your neighbor's portfolio. Stop scrolling through financial gossip as if it matters. Envy won't make you richer. It won't make you wiser. It will simply push you into dumb decisions. Your retirement doesn't care if someone else made more. Your family doesn't care. The grocery store doesn't care. Only your ego cares. And ego has bankrupted more investors than any bear market ever did. Now, let me share something important. My mistakes have probably taught me more than my successes. Everyone loves hearing about big winners. Very few examine the losers. But that's where the real education lies. Decades ago, I bought into a company that looked very attractive. The numbers were good. It was cheap on paper. Management seemed capable. I made a quick profit and sold. If I had held that position with patience, it could have doubled my net worth. That's not exaggeration. That's compounding. The mistake wasn't the stock. The mistake was me. I lacked the discipline to sit on a truly great business. I settled for being right in the short term instead of being rich in the long term. Most investors do the same thing. They sell their winners too soon and cling to their losers too long. It should be the exact opposite. Human nature craves certainty. When something goes up, people rush to lock in gains. It feels safe. But selling a great compounder early is not safety. It's quiet self-sabotage. In the 1970s, selling Coca-Cola after a modest gain felt prudent. In hindsight, it was foolish. That stock kept compounding for decades. People who sold early were congratulating themselves while quietly robbing their future selves. I don't waste time beating myself up over it now. Regret is useless. But I do use that memory as a rule of thumb. If you find a truly great business, sit on your ass and hold it. Don't get cute. Don't let every headline push you into action. The world constantly wants you to do something. Elections, wars, inflation, recessions. Most of it is noise. Good businesses survive. Great businesses thrive. Your job is not to react to every crisis. Your job is not to sell the goose that lays golden eggs. For people over 50, this is even more critical. You don't have endless decades ahead of you. One badly timed exit, one clever switch into something speculative can permanently shrink your nest egg. I've watched people hold reliable dividend stocks for decades, then read one newsletter about some disruptor, and suddenly decide to rotate. They dump rock-solid companies like Johnson & Johnson to chase some new tech IPO. A few years later, their income is gone and their portfolio is bleeding. The mistake isn't failing to predict the future. Nobody can predict the future. The mistake is abandoning what works to chase what excites you. Excitement is not a strategy. It's a trap. I could have been richer if I'd learned this earlier. At least I learned it. Many never do. They spend their whole lives hopping from one opportunity to the next, while the boring investor next door quietly builds real wealth. In the end, wealth doesn't come from brilliance. It comes from endurance, from the ability to hold on when everything around you is screaming for action. Now, let's talk about overconfidence. The older I get, the more convinced I am that most people are far too sure of themselves, and markets punish that arrogance sooner or later. Over nearly a century, I've seen waves of false certainty. In the 1930s, people were certain prosperity would never return. In the 1960s, people were certain big U.S. companies would grow forever. In the late 1990s, there were certain tech stocks only went up. Each time, that certainty was shattered. Confidence feels wonderful, but it has very little correlation with accuracy. In fact, the voices that sound the most confident are often the most wrong. The world is too complex for you to know everything. You don't get rich by being a know-it-all. You get rich by knowing what you don't know and avoiding it. When Warren and I built Berkshire, we passed on thousands of deals. We didn't understand them well enough, so we moved on. We didn't miss much. The world throws endless pitches. You are not required to swing. Most investors can't resist the urge to opine on everything. They think having constant opinions makes them smart. They'll tell you where oil is going, where interest rates will be, what country will boom next, which startup will change everything. But they don't tell you that most of those opinions will be wrong. After 50, that habit becomes deadly. You don't have the same margin for error as a young gambler. If you back your half-baked opinions with real money, the market will not forgive you. And unlike at 30, you don't get another 30 years to rebuild. I once watched a successful lawyer in Los Angeles decide he was now an expert on currencies. He read a few articles, formed a strong view, and bet heavily against the yen. It wiped out most of his retirement savings, not because the yen was evil, but because he was too confident in his ability to predict it. If he had simply said, "I don't know," and left his money in something boring and reliable, he would have been fine. But people would rather be loud and wrong than quiet and wise. So here's my recommendation. Develop the courage to say, "I don't know." It's a rare and powerful habit. If you can admit ignorance, you won't throw your money at nonsense. You'll stick to what you actually understand. At Berkshire, we knew insurance. We knew Coca-Cola. We knew See's candies. So we bought those. We didn't really understand airlines or early dot-coms, so we left them alone. That simple discipline saved us from disaster many times. Overconfidence ruins more investors than recessions. It's not the market that kills you. It's the illusion that you know more than you do. If you're over 50, stop acting like an oracle. You don't need opinions on every sector, country, and trend. You only need to understand a few things well and admit you know nothing about the rest. And remember this, the more certain someone sounds about the future, the faster you should walk away. The world is full of people eager to sell you certainty. None of them will pay your bills when that certainty explodes your portfolio. The next time you feel the itch to predict the unpredictable, stop and ask, what if I just don't know? That one question could save your retirement. There's another divide I've seen over and over. Some people think like employees. Others think like owners. This has nothing to do with salary or job titles. It's about mindset. Most people, even very smart ones, spend their lives playing career games. They optimize for promotions, titles, office status, and pleasing bosses. They polish their resume instead of building wealth. That's careerism. And it's a trap, especially as you age. I've often said the world is driven more by envy than by greed. Careerism feeds on that. You see the colleague in the next office get a fancy title, and suddenly you want one too. But titles don't compound. Ownership does. When Warren and I built Berkshire, we didn't care how important we looked. We cared about owning things that made money while we slept. Candy companies, soda companies, insurance firms. They didn't care if our business card said chairman or assistant to the chairman. They just sent us checks. Meanwhile, I watched brilliant lawyers and bankers waste decades climbing corporate ladders. They earned big incomes, but owned nothing that worked without them. The day they stopped showing up, the money stopped too. That's not real wealth. That's a high-paying treadmill. Back in my law days, I worked with some of the sharpest minds you could imagine. They billed hours, racked up income, and thought they were kings. But if they dropped dead, their income dropped dead with them. They were rich employees, not owners. Warren and I focused on building ownership. We wanted businesses that would earn whether we were in the office, on vacation, or in a coffin. That's the difference. If you're over 50, this question becomes urgent. Do you own anything that works for you when you're not working? Rental properties that generate rent? Stocks that pay dividends? A business stake that doesn't collapse if you take a month off? If not, you're not really investing. You're just extending your career. Careerism also clouds judgment. Employees think in terms of pleasing bosses. Owners think in terms of surviving reality. Only one of those perspectives compounds wealth over time. If you're over 50 and still living month to month, no matter how big that paycheck is, then you've probably been optimizing the wrong game for too long. The good news is you can still shift. Stop caring about job titles. Stop caring what colleagues think of your status. Start caring about ownership. That doesn't mean quitting your job tomorrow. It means directing your savings and your energy into assets that outlast you. Buy boring, durable businesses. Live below your means. Own things instead of just looking successful. Nobody will applaud you for quietly buying shares of Procter & Gamble. But in 20 years, those shares will be sending you checks when all the applause for promotions has long faded. Careerism fades. Ownership compounds. Choose the one that still matters when you're 70. Let me take you back to where my mindset began, the Great Depression. If you lived through it, you never forget it. I was born in 1924. By the time I was a boy, the economy had collapsed. Banks failed. Businesses disappeared. Families struggled to afford food. People today think a 10% stock market drop is terrifying. In 1932, the market had fallen almost 90% from its peak. That wasn't volatility. That was obliteration. I watched grown men lose their livelihoods. Families moved in together because they couldn't pay rent alone. My own family had to cut corners on everything. It was bleak, and it burned one lesson into my brain. You cannot assume good times will last. People today forget that. They think prosperity is the default setting. It isn't. Economies rise and fall. If you live long enough, you'll see both. The Depression taught me to respect reality. Optimism is fine. Blind optimism kills. In the 1920s, people borrowed heavily and speculated like crazy, convinced the party would never end. When the crash came, debt destroyed them. That's why I've always despised debt. It makes you fragile. With no debt, you can survive bad times. With debt, bad times can wipe you out. Another big lesson: resilience beats brilliance. I saw modest, boring businesses survive the Depression through thrift, discipline, and flexibility. Meanwhile, flashy operators with clever schemes vanished overnight. The survivors weren't the smartest. They were the most durable. Most investors still don't understand that. Everyone wants to be clever. Very few are willing to be durable. And yet, durability is what gets you through a once-in-a-lifetime collapse. I carried those lessons into investing. I don't waste time trying to guess the exact timing of recessions. Nobody can. Instead, I assume they will happen and I prepare. That means having a margin of safety. That means avoiding leverage. That means owning businesses that sell products people will keep buying in good times and bad. Chocolate, soda, basic insurance. People laughed when we bought See's candies. How rich can you get selling chocolates? Well, it turns out people eat chocolate in recessions too, sometimes more of it. See's survived downturns that crushed more glamorous companies. That's the kind of lesson you only learn from seeing real hardship. If you're over 50, you don't get a second Great Depression to relearn this the hard way. If you blow up your finances once, you don't have enough time to fully rebuild. That's why your portfolio has to be built for resilience, not fantasy. When you hear people boasting about leverage, complex strategies, or how they've hacked the market, remember the breadlines of 1932. Remember the men who thought they were geniuses standing in soup kitchens. The world has changed. Human nature hasn't. People still get greedy, still borrow too much, still assume good times will roll forever. Every few decades, reality corrects them. Learn from history you didn't live through. You don't need another cataclysm to understand risk. All you need is humility and memory. If I had to reduce my own success to just 3 habits, I'd say this: I avoided debt. I avoided drama. I avoided dumb people. That's it. No magic, no secret formulas, just subtraction. Debt, as I've said, is poison. It magnifies your mistakes and guarantees that when things go bad, you're first in line for destruction. Warren and I could have juiced our returns with more debt, but one or two wrong bets with leverage, and we'd be done. We chose survival over flash. Drama is just as dangerous. I have no interest in unnecessary conflicts, ego battles, or personal chaos. Drama wastes time, energy, and clarity. Plenty of intelligent people were not ruined by bad investments, but by bad divorces, bad partners, and bad tempers. You can be brilliant with numbers and bankrupt yourself with emotions. Then you have dumb people. And by dumb, I don't mean low IQ. I mean people who are reckless, dishonest, unreliable, or addicted to shortcuts. These people are radioactive. Their problems become your problems. In my early career, I watched talented colleagues get sucked into schemes run by smooth-talking operators. Same pattern every time. Big promises, shady details, ugly endings. I chose a different path, fewer partnerships, higher quality. My partnership with Warren worked not because we never disagreed, but because we shared the same basic principles: rationality, patience, honesty, low drama, low debt, low stupidity. That combination alone created enormous durability. Most people underestimate how powerful simply avoiding the wrong things can be. Everyone looks for the right stock or the perfect deal. They forget that saying no is usually more important than saying yes. One good yes can make you some money. One bad yes can ruin your life. After 50, this isn't optional. You don't have time for multi-year cleanups from bad decisions. So be ruthless. No unnecessary debt. No drama. No stupid people. It might sound harsh. It buys you peace of mind. And peace of mind is worth far more than squeezing an extra % or 2 out of your returns. People romanticize my partnership with Warren Buffett. They imagine two legends in a tower, always aligned, always brilliant. That's a myth. What actually worked was simple: trust, compatible thinking, and discipline. We trusted each other. No politics, no backstabbing, no jealousy. That kind of trust is incredibly rare in business. It saved us a lot of wasted energy. We thought in similar ways about money. We both valued patience, rationality, and independence over fashion and applause. If something didn't make sense, we passed, no matter how crowded or popular it was. Our skills were complementary. Warren was exceptional at identifying undervalued businesses. I kept him from getting too attached to so-called cigar butt stocks, cheap, low-quality companies that give you one last puff of profit and then die. Together, we focused on buying quality at fair prices and then holding. That shift alone was worth billions. Were we perfect? No. We occasionally backed the wrong managers. Character is hard to measure on a spreadsheet. When we got it wrong, it cost us. We also sometimes thought we could improve weak corporate cultures. In reality, if the underlying culture is rotten, fixing it is almost impossible. We also missed opportunities, especially in areas we didn't understand well, like early technology. Did that cost us upside? Sure. But I'd rather miss a big win than suffer a big loss doing something I never understood. Our real edge was knowing the limits of our knowledge. Most investors don't have that. They want to have an opinion on everything. We didn't. We stayed inside our circle of competence, and that explains much of Berkshire's endurance. If you're over 50, you should think carefully about your own partnerships, business, financial, and personal. Ask yourself, does this person make me more rational or less? Do they bring stability or chaos? Do they amplify my strengths or my weaknesses? The wrong partner can destroy decades of work. The right one can multiply it. Now let's return to you and your age. Getting rich after 50 is less about genius moves and more about avoiding fatal ones. At that stage of life, survival is the strategy. You can still build wealth after 50. I've seen it many times. But the people who did it didn't day trade like college kids. They were boring, consistent, and rational. You don't need to double your money overnight. You just need to stop blowing yourself up. I once knew a doctor. Solid income, reasonable lifestyle. At 55, he started steadily investing his savings into high-quality, dividend-paying stocks. He reinvested his dividends, avoided flashy trends, and lived below his means. By 70, he wasn't on magazine covers, but he was financially free. No debt, strong income, no fear. Another man I knew was an entrepreneur who felt behind at 52. He threw nearly everything he had into speculative, highly leveraged real estate deals. When the market turned, he was bankrupt by 57. The difference wasn't intelligence. It was discipline. If you're over 50 and want to get rich or stay rich, here are a few simple rules. Keep it simple. Only own what you truly understand. If you can't explain an investment clearly to your spouse in under a minute, you probably shouldn't own it. Preserve capital. Every dollar you lose at 60 is far more expensive than every dollar you lose at 30. You don't have the same runway to recover. Avoid envy. Don't chase the guy who doubled his money on some risky bet. In most cases, he won't keep it. Your job is not to keep up with him. Your job is to still be standing when he's gone. Play defense. A steady 7% return compounded over 15 years starting at 50 is powerful. Your money doubles and then doubles again. By retirement, you'll look rich to anyone who spent those same 15 years chasing fads. Most people over 50 forget this. You don't have to be spectacular. You have to be solvent. The world ends up rewarding those who simply endure. I didn't become wealthy because I was a genius. I became wealthy because I avoided stupidity for longer than most people, and I let compounding do the heavy lifting. I overshot. That's how this game works. Now here's the final, blunt truth. If you are not spending less than you earn, nobody can help you. Not me. Not Warren. Not the best advisor on earth. The laws of arithmetic do not care about your feelings, your lifestyle, or your excuses. If more money flows out than flows in, the result is guaranteed. You go broke. I've seen high-income people end up poor in old age because they couldn't resist spending everything. And I've seen modest earners die comfortable because they lived simply and invested consistently. It wasn't talent. It was behavior. Overspending destroys any investment plan. It doesn't matter if you're 25 or 65. If you keep digging the hole deeper, compounding turns into your enemy instead of your friend. People ask me all the time, what's the best investment at my age? My answer usually starts with, stop buying things you don't need. That one habit alone would solve half the financial suffering in the world. After 50, the consequences of bad behavior are sharper. You don't get infinite do-overs. Your choices now decide whether you retire with dignity or dependence. The goal at this stage is not glamour. It's not impressing anyone. It's dignity, independence, the ability to know you won't have to beg your children for help or work until you drop. That doesn't come from clever trades. It comes from restraint. If you avoid debt, avoid drama, avoid dumb people, live below your means, and invest simply and patiently, you've already beaten most of humanity at the money game. Do that long enough, and compounding will handle the rest. If you overspend, nobody can save you. Not me, not the market, not a miracle. Arithmetic always wins. So let me leave you with one question. When you're 70, do you want to be envying your neighbor's toys or enjoying your own freedom? The choice is obvious. The execution is rare. Remember, the world doesn't reward brilliance nearly as much as it rewards the ability to avoid stupidity. And nothing is more financially stupid than spending yourself into misery. That's all there is to it.